All right, well, thank you everyone, and thank you for joining our webinar, and welcome to Penny. We're thrilled to work with you. We are actually a top life insurance and annuity BGA, and our goal is to help insurance agents write bigger cases and make much more money. So before we dive in, here's what sets us apart. And you'll notice on these slides that I have Renaissance art with futuristic technology depicted. That represents who we are. We're classic. We work with old school advisors that are interested in truly building a lifelong relationship with clients. And here's what you'll get with us. You'll get top underwriting for large cases. You'll get a dedicated A team to handle your apps. You'll get free access to our CRM Insurio. Also, tons of free tools like IGO and Firelight, and you'll receive ongoing training with advanced strategies. And bottom line, we're here to help you grow. So let's get started. And one of the benefits of working with us is education on higher level concepts. Most life insurance agents only write terms. So if you go into permanent policies or get into business owner solutions, you can actually triple your premiums. So without further ado, I'm going to turn it over to Matthew. I'm going to stop sharing.
All right, thank you very much, Chris, and thanks everyone for joining. We're going to get right into the presentation. I will just let everyone know that I do not see the chat while I am presenting. Chris, if you can let me know if questions pop up. There will be a dedicated question time at the end. So that way, if we don't get anything during the meeting, we'll be able to cover it at the end. So
sounds great.
Thank you. So today's topic, we're going to cover 529 plans versus IULs. And some of you may be asking, why is this even a subject we want to cover to begin with? And to be frank, it's because most clients have limited funds. They only have so much that they can put into different types of asset classes. And then they have to make the choice of how they want to use those funds and what vehicle they want to use for them. So really, when they're looking at a college education for their children, these are two ways that they are able to fund that education, both with some positives and negatives, and we're going to cover those for you. So we're going to go over some of the features, benefits, and drawbacks of both 529 plans and IULs. We're going to do a comparison of the concepts with some cold hard numbers to kind of reinforce the information that we're going to go over at a high level. And then at the end, we're going to cover some when to sell which. So first off, we're going to talk through 529 features and benefits. So 529 plan, you're going to get that tax deferred growth and a tax-free qualified withdrawals. And the qualified withdrawals from 529 plans are, of course, educational expenses. The product is structured for these educational expenses. And I will say that versus IUL, you will generate more cash value in early years. And most times, barring a massive market correction right before a withdrawal was to happen, you'll have more cash value at the start and end of your college payment years. 529 plans also have lower fees, some to be close to zero. There are some drawbacks though. If you are going to take any type of withdrawal, there is going to be a 10% penalty for a non-education withdrawal. It may suffer losses because it is a investment-backed vehicle, so it does have exposure to the market. So with that said, you are going to get that upside of the market, but you can also get that downside, and especially where those happen in the timing of it can affect the overall performance. Whether those down years happen at the start or at the end, that can really affect the 529's performance. What I'm going to focus on for a brief moment as a major drawback to these is the fact that it's considered an asset on FAFSA. So when you're actually applying for the aid, when you're listing out everything that you have that is able to have, help pay that, they ask, hey, what can the parents contribute? A 529 plan is going to have to be listed as one of those assets that is able to contribute to funds, which means that, the child in question may have less assistance, may be able to get qualified for less loans, and this can also affect uh, performance-based scholarships where two otherwise equal candidates, a school may weigh that the one that does not have a 529 plan as the winner of that scholarship versus somebody that has the means to pay for that merit-based scholarship in other ways. So it's definitely something to think about because, like I said, this is educational focused, and one of the things that it's focused on, it actually counts against. In contrast, when you're looking at an IUL, you're still going to have that same tax deferred growth, and you can have tax-free withdrawals when structured correctly, which means, loans on the policy. It is a policy that's structured for multiple purposes. So unlike 529, which is locked into gaining the most benefit from college education or other educational related expenses, in IUL, you're going to have access to those funds for any type of need that you have. Another thing, and what most importantly, it is shielded from the FAFSA. So because it is a death benefit product and it's a life insurance product, when you're listing all your assets, to qualify for financial aid, it's not something that you have to list. Even though you can access the cash value to pay for college, it's not something you have to list as a asset that would count against you. It does add added death benefit protection, which really is something that I think goes maybe a little underserved when talking about these type of plans. So we're going to go into some more numbers and some, deep dive into these plans a little later. But these are going to assume, funding for 15 years. Well, what happens if the client can only fund for 3 years and then the unfortunate happens and they end up passing? Well, 529 plan, you've only had those 3 years of contributions, and then you have to hope that that can grow into what you need. Whereas in IUL, you're going to have that death benefit protection that's going to be that payout that you can then choose to put away for college expenses in the future. Another thing about IULs is they can provide an income stream, and we'll show an example of that as well later. I will note that, dollar for dollar, when you're comparing these two types of assets against each other, an IUL is going to have less cash value in the early years, due to, surrender charges and just the fact that you have to pay for that death benefit. Life insurance as itself does come with fees attached. And so those fees do put a drain on kind of that cash value that you'll have. And then there will be some less cash value at the start of the college payments. Now, these both sound like drawbacks, but really when we take a real world example, it's not as drastic as it's making it out in these bullet points. But I do want to mention that if you're looking at dollar for dollar, life insurance will have less of a cash value, and that's because you're having something that's a little more protective. The fact that the 529 is market-based, you are able to get those home runs, but you also have those down years, so that additional risk should come with additional rewards. So speaking of which, I'm going to just show an example right now of 529. This is assuming $15,000 every year for 15 years, 7% with no fees. So that means zero money coming out of this policy. This is a true 7% growth. This is from an Excel sheet, 15% times 7. That's what it is, add it together, and then you keep totaling up. So you see that 7% every year, the account will grow. And then you'll get, in this case, for the 4 years after year 15. So this would be, when the child's going to college, because we're going to have this be, on a 3-year-old. So they've had a couple years already. You're getting 65,000, and you're going to have, 188,000 left in cash value within this policy for future needs. Don't have to worry about memorizing these numbers. All the important things we'll come back to later. But I just want to point out that this is in its most simplest and raw form, just straight accumulation on 15,000 at 7%. And even when it's taken out that 65,000, it's still getting 7% on that difference to continue to grow and offset the deductions from the account. Now we're going to compare that to an IUL. So this one is taken from one of the many carriers that we have. I kind of took the numbers from the illustration and put them into a spreadsheet because there's lots of columns, as you know, in those detailed summaries of an IUL to kind of focus on the ones that we're looking at. And even though this is a generic agnostic representation, we do work with a lot of the major carriers, F&G, Corebridge, Securian, Prudential, just to name a few. So your favorite IUL carrier would have something that would fit this. So we're going to have that same $15,000 a year premium going in, that same $65,000 coming out for the 4 years to pay for college. And you'll note that the surrender value after that is 112. So when we look at these two in comparison, the value when your last contribution went in, so this is right before you start taking out for your college expenses, you're going to have more in the 529 plan as you would because you're taking that greater risk to expect that greater return. And then you're also going to have a higher value after you're done with your withdrawals. So after you pay for the 4 years of education, you are going to have additional funds and additional value still within the policy, and that 529 is going to have a greater value at this point in time. But as I said before, we're going to talk about some real world examples. You know, child goes to college for 4 years. Well, now that you've paid for the children's education, what are you going to use that 529 plan for? Well, you could use that as income. So I fast forwarded a couple of years. So they start taking income at age 66, you know, the retirement age. They're going to be taking out 33,000 and some change in a distribution. But because this is not an educational expense, they're going to be hit with both taxes and penalties. So they have a 10% penalty for a non-qualified withdrawal. And since they're in retirement years, I'm just showing a flat 15% income bracket that would vary based on the client and what other income they receive in those years. But assuming that 15% plus that 10%, they have 25% in taxes and penalties off of that next distribution. You're still getting 7% growth, and that account value is still holding up a little bit, but you'll see that in this illustration example, you're only getting 11 years of that income before the account kind of bottoms out and goes negative. Now, when we compare that to an IUL, you're going to have that same death benefit protection on top. The surrender value is different, so it's 211 versus previous 283. So once again, the account value in the IUL is higher for the cash value if you're looking at just that number on the 529 than the IUL. But the IUL is able to give you that same 33,000 and some change distribution. This is your standard 20 years max distribution for starting at age 66. And you see that even though it has lower cash value, this policy can support all 20 years of surrenders. And then I would also note that since this is a tax-free distribution from the policy due to it being a loan, you are getting in pocket that mailbox money of the full 33,000 without having to worry about having taxes taken out on top. And the reason for that, when you say, well, why is it that a 529 having more cash value is having lesser returns? And it's the fact that when you take money out of a 529, just like any other investment-backed vehicle, you're taking the money out, that money no longer earns you any growth. So every dollar you take out is a dollar that's not providing growth. Since these are policy loans on the IUL, you'll notice that the account value, the total value of the account, not what you have available for cash, continues to grow. And that's what you're going to be getting growth on, is that total account value, which is why an IUL and other cash-based insurance products are able to perform better, even though a dollar for dollar they have a lesser cash value number. So that's just something to understand, that when you're talking to, parents and clients for this, and they see, well, this 529, it has, a ton more money in it when, based off of the numbers that I'm looking at. Yes, but does it retain that value when you need to use it later? So once again, that same value before and after. Then we're going to add income and that value after the last year of income. So the 529 could give 11 years of income and leave you with 27,000 left over. The IUL, after taking 20 years of income, still has over $200,000 of value left. And this particular illustration went to 121, and at 121 was in the multi-million-dollar range. So it continues to grow, due to the fact that you are growing off of that account value, not necessarily the cash value that you have access to. So that's an important fact to remember. So if you're going to compare dollars to dollars, so let's say you were to try to get that $33,000 from the 529 plan and take it out as cash in your pocket, you're going to cut the number of income years in roughly half because you have to pay taxes and fees on that. So you end up having to take out a lot more money, which once again limits the growth and limits the amount of years that you have access to that money. So this brings us to the final question, and hopefully there's some questions and answers in a moment of when to sell which product. And that's really going to depend, and this is a little bit of a cop-out answer, on what your client's needs are. There's no right or wrong answer to this. If the client has a short time horizon, let's say they need to access the money in 3 to 4 years, life insurance, as you know, is a long-term asset, and the cash value needs some time to grow in order to be able to fully be accessed. So short time horizon, 529 is probably the way to go. If you have that time and the client has the time to let the product build up, has the ability to have that death benefit on top, and really has that flexibility in what they want to do with the value in there, then the IUL really blows the 529 out of the water with all those facts. Even though, as I said, the actual cash value, that number on the spreadsheet or the illustration or whatever it is you're looking at, may be slightly lower, the real world of how that money works when you actually start taking withdrawals out, that you start accessing these funds and you want to access them for more than one thing, the IUL clearly wins out on that. Now, this was a short presentation, so I know we have scheduled for a while. I'm hoping there's some questions and answers, because really I think the Q&A portion is really going to dive into some of the benefits and questions that we're looking at for that. And I think there is a couple questions in chat.
Yep. So we have
okay.
one question. If a family already has a 529 plan, can it be transferred into an IUL?
So yes, but not easily. There are no rules that I'm aware of being able to 1035 that from that 529 into the IUL. So it's not like moving from one insurance contract to another, because they are different vehicles. You'd have to think about it as, if I have an investment in an account that has this amount of money and I want to transfer it, you're probably going to be hit with penalties and fees before you're able to put it into an IUL. So can it happen? Yes. Is it as easy as a normal 1035 between two similar products? It is not. With that said, if that's something a family is looking at, it would be good to see that even with that hit to the money that they have in there, if an IUL would still outperform them in the future, with the fact that they have that income that can have been after, as well as have enough money to pay for the expenses with all the other features that an IUL has. So it's definitely something to talk to one of our brokerage managers about, if you do have a client like that, because then we can dig into the numbers and see, is that a smart transfer for them, or should they stay with the 529 and continue funding that based off of what they have?
Cool. And I personally have a question. So
Sure.
what happens to a 529 if, let's say, like the child doesn't go to college?
Uh, so if the child doesn't go to college, now anytime you want to access that money, it's going to be the same as we looked at on the income portion of that. You're going to be hit with a 10% fee, and then also most likely an income tax on that. So can you access the money from the policy? Yes. If it's for a non qualified expense, you are going to have to pay that penalty as well as tax on it. So that's where the versatility of an IUL comes in, because you're not locked into having to use those funds for one particular purpose. You're really able to use those funds for any need that you might have. And as those needs change, the way you can use those funds change. Maybe the client's child gets a full ride and you don't need that, but then they want to start a business after. The money that you could have used, take it from your IUL, and then use that as seed money versus having to take that hit from the 529. And as we saw, the 529 is not able to sustain those types of withdrawals for a long time after, based on the fact that you are removing the asset, thus removing its growth. I think we have
Cool.
another question in there as
Yep,
well.
we have another question. Yep. Is it possible to take the excess from the 529 after paying for education without being hit with penalties and or taxes? Or does it have to be used for education purposes?
So the 529 does have to be used for educational purposes. Um, Anything that is after that does have to be for qualified expense. Um, so there are some ways to potentially move that money. I think I see a message from Tom in there as well. Thank you, Tom. Um, Move that money into an IRA or another investment vehicle under certain conditions. But anytime that you use that money or touch that money for non-education relation expense, there are going to be some restrictions, penalties, and other kind of things that you have to look at. It's not as easy as saying the child's education is done, I get the extra money. The way that you should be playing the 529, which is very hard because you have to base on the market, is you want to basically fund it with just enough to pay for the college expenses, but you don't know what the college expenses are going to be like in 15 to 20 years from now. You don't know what return you're going to get. So most people end up overfunding a 529 to make sure that they have that money available, which means that they do end up with excess money that they then have to figure out what to do with. Um, 529 can change beneficiaries, so you can have multiple children on there, but there are things you can do with that, but it really is educational expenses that it's designed for, which is why it's the low fees and stuff, because it's locked into what that money can do without any other restrictions.
And I know, so a lot of parents have multiple children. So
Mhm.
is one better than the other for funding?
I would say if you have multiple children, I would probably go to something like an IUL, only because you now have that ability to fluctuate what you can take out and have that growth all rolled into one. So instead of funding multiple plans at different times, as you have a child, 1 year, have a new child, 3 years less, if you're funding an IUL through that, you can then take out more money. We showed 65,000. You could take out more than that and still have the policy work. Um, but just note that that would then affect the income you get later. But you do have that flexibility within an IUL to adjust what you're going to use it for and how much you take out at any given time, and also over any given period. So you may do 3 years of one amount, 1 year of double that amount because you have both children in college, and then 3 more years at a reduced amount. As long as it's funded correctly, an IUL would be able to sustain that.
And we have another question that came in. So many educators have modest discretionary income. What are the realistic contribution levels that make an IUL viable and not over leveraged?
So that's really going to depend on kind of what their return they want on the other end is. So um, you are correct that when you're looking at these types of plans, there is that ability to overfund it. But it's really going to be what is it that you're trying to fund in the end. If your sights are on a state school or something that may have a lower cost, you know what I mean? It's really, or you're trying to plan for Harvard. So the contribution levels are going to kind of determine what that final result will be and how much towards the education expense that you're going to want to put in there. And that's the same thing with contributing to an IUL. You could run illustrations. We showed 15,000. You could run illustrations for 2 or 3,000 a year, which might be a more realistic scenario for a lot of people. But you're not going to get out 65,000 over the 4 years. So just like any type of investment product, the kind of what you put in is going to determine what you're able to get out. I hope that answered your question. It's not as simple as there's a number that you would need to do in there. It really is what is the client comfortable for, and if they have needs other than just the education, then the IUL starts making a lot more sense because the money that they're putting in is now being able to be used for more than one type of thing.
And we have another question that came in. So what
Okay.
happens to the 529 fines if the parents die?
So that's a good question. There is going to be a beneficiary on that. There is a ability to transfer ownership on those, but it's still going to be locked to educational expenses for the child. So having the parents die does not like get you a payout like it would in life insurance, which is why, like I said, when we were looking at that example of someone passing 3 years into the funding, you're kind of locked into the funding that was there, having to grow, and it doesn't get paid out in any way once they pass. And that's the same thing that happens. Let's say you're looking at those income years, like you're taking the income from the 529. There's not an ability to, when the client passes, say, okay, well, we're going to pay the rest of this out. It's still locked for educational purposes. They were able to take it out with those penalties, unlike an IUL where if they happen to pass during those income years, the full death benefit would be paid out.
And we have another question that came in. Can you break down the commission and administrator fee structures of IULs?
Uh, in a nutshell, each IUL is going to have a little bit of separate fees, but because it's an insurance product, you're going to be paying. There's a death benefit fee. There's, there's going to be fees in an IUL that affect the performance. Most companies' illustrations will show what those fees are in any given year. As for the commission, that's a question to talk with the brokerage manager on. We pay really competitive commissions, and a lot of them are going to be really good value for the money versus what you might make if you were to sell that 529 plan as well for that same type of structure. So I hope that answered your question, but the admin fee is really going to be based off of what product you sell for which company on kind of what those fees and levels are, as they do differ slightly from carrier to carrier. But all those numbers that I showed you in the IUL illustration were including fees. So this, surrender value is the amount of value you have in the policy after all fees have been taken out every given year. So that would be any loan interest you have to pay on the outstanding loan. That's any policy fees, death benefit, admin fees. That surrender value is net of all those fees of, saying like this is what your true value is each given year in the policy.
And I have a question. Can
Yep.
either option be used for private school or non-traditional education?
So IUL, yes, you can use it for whatever you want. 529, it has to be a qualified. I have not read that you are not able to, but I will be honest that I have not looked up if private schools can be used for that funding. So I would have to circle back with everybody on that. I don't want to give incorrect information. I don't believe there's any restriction, but let me double check that to make sure that that's just because I haven't read that restriction somewhere.
Sure. And we have another question that came in. Can an IUL also be structured to help fund adult continuing education or professional certifications, and which are common among educators themselves?
Yeah, so the nature of the cash value within an IUL is that the cash value within it is able to be used at any time. What I would caveat on that is if it is an educator that's looking to help fund education for themselves, the nature of the time horizon requires that they're not really going to get as much money in the first year. So if we go back to this example, put 15,000 in, their surrender value, because there are surrender charges and a lot of IULs for the first so many years, you're only having access to $6,000 of that value to pay for education. So you really need to have a kind of time horizon to pay for those educational costs. With that said, the money can be used for that. It's just that might be where a 529 plan, if they're looking for funding for a short-term expense, something that they know that they're going to have 2-3 years down the line, might be a better avenue to consider, because the nature of the way that a life insurance policy works, you kind of need to give it the time to work. Because if we look at that same 529, at the end of the first year, you have $16,000 in value. Now, I will also caveat the 529 is market-based. So it's possible that that first year is a down year and you don't have that much available. So that's the kind of give and take of both of these, is the fact that the IUL is going to give you a little more predictable results. You're never going to, zeros you hear, you're never going to get less than the zero and then some fees. Whereas the 529, you could actually have a negative return year. Given a long enough time horizon, it normally averages it out. But if someone's looking to fund education in the near future, it's just another kind of thing to consider, which is why there's no hard and fast rules on which one's which. It's really going to be their ability to tolerate the risk in the time frame that they have and when they're looking to fund. So I think the longer they have to fund, the more an IUL is attractive. The shorter they need the money, the more 520 might be the way to go.
And we have another question that came in. Is a securities license required to sell 529 plans?
That is something that I am securities licensed, and I don't know. Yeah, so you do need a Series 6 or 7. Thank you, Google, for the quick update to sell a 529 plan. I don't personally sell 529s, even though I'm securities licensed, so I did have to look that up. But it is a market-based asset, so it does fall under the securities rule. You would have to be securities licensed, which is different licensing than for life insurance. It would be the same licensing you would need to sell variable products.
And I have a question. Are
Mhm.
withdrawals from either plan guaranteed, or can they be denied or delayed?
So the withdrawals from either plan are guaranteed a word. They are available as long as there is a value in the policy. So a 529 plan is not going to guarantee any performance results, but if in any given year you have $50,000 in it, you can take out half that money. There's no limitation for that. To as long as the value's in. The same with an IUL. I would always say that whatever you're thinking of taking out an IUL, run an in-force illustration with that as a sample to make sure that the IUL is able to sustain itself and doesn't lapse. But the money that is there is able to be taken out. The carriers are not going to say you're not able to take this money. Once again, assuming that that is the value you have there. So in the early years of an IUL, if you were to say, hey, I want to cash out in year 2 in this example, you're only going to get 21,000, even though the account value has 28 because there's surrender charges. But the company is not going to deny you that 21,000 if you did want to cash it out.
And what role do these plans play in a larger financial plan, like retirement, estate planning?
So this is where, like I said at the beginning, that most people are trying to juggle limited funds. It is part of an overall kind of structure. The 529 would be where you want to use this money instead of leveraging it in other assets. But if you're already, well within, a 401k or whatever for your own retirement, life insurance can be a good supplement to that. 529 is taking money that you would put into another retirement vehicle and dedicating it to education-only expenses. So part of the way I like to look at life insurance is that's, I think, a better fit into an overall retirement strategy and overall kind of a wealth building strategy, because you're able to use those funds for multiple things like you are with other wealth building aspects, whereas the 529 is locked in, and the funds there are not able to fund retirement without those penalties that we saw in there.
And we have another question that came in. Is there a readiness assessment you recommend to determine if a client is better suited for a 529 or IUL?
There is not, but that is something that I think we could probably take away as something we may want to put together. It's really going to be in conversations, the what's your time horizon, what's your risk tolerance for market exposure, and what do you want to use these assets for. If their time horizon is short, 529 is probably the plan. If they have no risk tolerance to market, IUL is probably a better choice. If they want to use their money for multiple things, IUL might be a better choice. So it's really going to determine on which way they want to use that, and kind of what it is that it fits into an overall plan for them. So I think we could probably put something together, but it's more than just a questionnaire. It's part of a deeper overall strategy of what they want to do with the funds that they have for these type of instruments.
And I have a question about mainly about suitability.
Okay.
So, like in your experience, what are the common mistakes people make when choosing between basically between these two plans?
So coming from the insurance side, what I find a lot of people who have talked to me that they've done a 529 and wish that they have done insurance instead, is when they realize that the funds are kind of locked in and that they don't have kind of that self-completing nature of an insurance policy. When you start talking to someone about insurance, you of course bring up mortality, and then when people think of mortality, they often go back to the 529 plan and go, hey, I didn't think about what if I can't fund this for the full time, what happens then? So a lot of times that brings into the question of, if I were to pass tomorrow, is this plan that I funded for however many years really going to be able to support the educational needs of the child? Or would I have been better spent putting that into insurance, because it has the ability to both grow as a cash value asset as well as have death benefit protection if they were to pass?
And we have another question that came in. How does an IUL support multi-generational planning or legacy gifting differently than a 529 plan, especially for families who, let's say, want to fund grandchildren or multiple dependents?
So that is a great question. When you're talking about legacy gifting, you're always going to want to talk about have they met their gifting exemptions and stuff yet. But for a lot of especially grandparents and stuff. I've seen insurance used as a great vessel to kind of put the insurance, on the child, uh, to have that be a gift to them. So that way it grows with them, and then they have the ability to, once they become of age, of using that money for college educations or for, their own legacy as well. So a lot of grandparents use, cash value products, like an IUL, for those gifting things because it adds those extra protections, and they normally do it on the life of the child in question. Versus in this example, we did it on the life of the parent. A lot of times when you're talking multi-generational planning, you'll be doing it on the life of the child, which is going to be a little different than what you do on a 529, which is still going to be, for the child, but it kind of locks them into what they can access that money for in the future. I don't know if there's any gifting exemptions to that, but I do know that there are limitations to how much that can be put into 529 plans, whereas for IUL, there's no such limitations on what can be put in. So I don't know what the current limitation is on a 529 plan. Like I said, I don't personally sell them, but they are something that the government does say you're only allowed to put X amount into a 529 plan versus an IUL where you are able to put in more than that.
And what are some of the biggest risks in an IUL that people like may overlook?
So an IUL, it is an index fund. So one of the things about an IUL that I think a lot of people maybe don't take into account is it's not a set it and forget it type of product. It should be reviewed yearly, every 2 years or so, to make sure that it's performing the way that you want it to perform. Because there is a correlation to the market. If the index returns to zero, you're not going to have the growth that you would want in there. So it's just something that you want to keep on. But that would be the same with any type of investment product. And this is the same with 529 plans of if you have a bad return year, you've now affected that future outcome. IUL has a little more ability to kind of help you catch back up to meet those goals versus what a 529 allows you to do. But it's definitely something that you want to look at every year. And I think a lot of agents who are new to selling it may not realize that it does require maintenance, even if it's just, yes, it's performing exactly how we thought it would be, to make sure that you don't, see it, 10 years from now and go, oh no, it's not looking how we had planned it. And if we had made this minor adjustment 4 years ago, we'd be on track. It's just something to think of, and that's something that a lot of new agents kind of miss is that maintenance factor of an IUL. And really, any type of product that you sell like this, you should be doing that routine policy review.
And does anyone have any other questions?
Okay. Well, thankfully, we left some time for the Q&A. After I had a feeling there'd be a lot of questions. It is a simple yet complex topic, but really what I would urge everybody to do is not look at just the raw numbers, but look at the story that the numbers are trying to tell and how that actually applies to what the client wants to do. What are they looking to spend on college? How many years are they looking to spend on college? What are they looking to do with the money after? And then we can work, for the IUL for that to tell that story, show what they're looking for. So that way you can better show that, yes, the numbers may not be different, but look, it's actually performing in your real life example of how you want to use and access this money better than something that may have a bigger number, but doesn't actually perform the way you would think once you start actually using it in the way that it was planned. So just go beyond just what's the total value before you start taking out expenses or distributions, I should say, and look at what that actually is in total.
And we have another question that came in. Can you provide a side-by-side comparison that can be used as part of my presentation for educators?
That is something that I will work with Dave Jones, another brokerage manager here on, see if that's something that we could put together for people on the call, along with that that kind of quick fact-finding sheet that you had talked about. We just want to be careful that when we are looking at side-by-side comparisons, that we're doing true side-by-side. I used all these examples. There's 1,000 caveats that you have to give when you're doing this with real world, when actually talking to clients, that we just need to make sure are done and put together to make it an actual something you can present. Just because, for compliance, there is a lot of things, that we have to take into account with that. So is it something that we could do? It's something we can look at, but it is something that's not as simple as here's these two numbers that I have, let's put them together. There's a couple more steps involved in that.
I believe there's another question that's coming in.
Okay. And just to make it clear earlier, I know we had talked about securities licenses needed. IUL does not need a securities license, so it's one of the benefits of it is that you can sell it without needing to be securities licensed. You only need your life license for it.
And a new question just came in. What is the best way for a grandparent to buy this for a grandchild? Would they have to put the insurance on the parent?
So that's going to depend on some different factors. I've seen most times that if a grandparent's buying, they skip the parental generation and put it straight on the grandchild. With that said, underwriting is going to ask, why are the parents insured? So there are some nuances to that. But for most insured families, I've seen that the grandparents go straight to the grandchildren to be the ones that they're putting the insurance on, assuming that the amount that they want to put in makes sense for that child's age. If not, then normally it does go on to the parent, where it might make more sense depending on how much the grandparent's looking to fund. But with that said, I've seen some pretty high numbers from some carriers on what they'll allow a grandparent to put in for buying a policy on a child.
And we have a follow-up to that question. Don't they want the parents to have double the coverage that the grandchild is getting?
That's depending on what the overall generational strategy is. You are correct. There are going to be coverages there, so that if the parent passes, there is that death benefit protection as well. It really is going to depend on what the overall family strategy is, but I've seen a lot of grandparents go straight to the grandchild with that, so that it's locked in for the grandchild, because part of that too is access to the funds. A lot of grandparents are there, they want themselves to be the owner, and then they'll have the child be that secondary when they're of age, with the parents as the beneficiary. But that allows the child to get access to the funds, whereas the parent would have access in the other example. So if they're trying to lock it in for certain things, I see a lot of grandparents taking that step to go right to the grandchildren. It's not right or wrong. It really is how they want to plan for that, but that's what I've seen more often than not in these types of strategies.
Cool. Are there any more questions?
Okay. Well, I thank everybody for coming. I know this was a short presentation at the beginning, but a lot of questions after. I hope I covered everything. We do have that takeaway of both can you fund private schooling with a 529, as well as some possible materials to send out after to help in these types of presentations when you're actually speaking to clients about why they might consider an IUL versus a 529. So look forward to working with you all in the future. Don't forget, if you have additional questions after this, contact your brokerage manager. And we're happy to go into more detail on a case-by-case basis as things come up and as you have clients that are looking for this and we want to dive deeper.
And we'll also be providing a recording to everyone who registered for this webinar. So be on the lookout for that. And thanks everyone for attending.
Okay. Thank you, everyone.
Yep. Thanks everyone. Bye.